Could the crypto cycle actually be over? It's no secret, over the last few weeks, crypto has not been so fun. It seems like just yesterday that Bitcoin was trading above $120,000. Confidence was sky high, leverage was everywhere, and talk of a super cycle filled every crypto feed. But then, in a single day, it all came crashing down. Nearly $20 billion in leverage positions were wiped out, the largest liquidation event in crypto history. Since then, Bitcoin, Ethereum, and especially altcoins have plunged, traders are panicking, and headlines are screaming that the bull market is finished. But what if it isn't? What if this historic flush was exactly what crypto needed before its next leg higher? According to top on-chain analysts, the structure of the current move crypto is undergoing mirrors previous mid-cycle resets, violent, fast, and ultimately bullish. The 20-week and 50-week moving averages still hold, ETF inflows remain strong, and macro liquidity indicators suggest that a powerful recovery could already be forming beneath the surface. In this video, we'll break down what's caused the current weakness in the market, why we saw it crash so sharply, and the data showing it may have cleared the path for Bitcoin's next rally. We'll also look at how Ethereum and Solana fit into this setup, what the global liquidity index says about the coming weeks, and why the biggest investors are treating this not as the end of the cycle, but as the perfect reset before liftoff. Finally, we'll hear from top experts such as Wall Street veteran Tom Lee on when they think the market will actually top out. And before we jump into it, just a quick reminder, only a small percentage of you watching are actually subscribed. If you're getting value from the videos, hit that subscribe button. It's free, it supports the channel, and you can always change your mind later. Now, let's break down exactly what happened, why this record liquidation might be the turning point everyone missed, and how it could set the stage for the next major crypto rally. Just a few days ago, Bitcoin was trading above $120,000. Traders were confident, leverage was everywhere, and social media was full of talk about a super cycle. Then everything changed in one day. Nearly $20 billion in leverage positions were liquidated, the largest wipeout the crypto market has ever seen. Prices dropped fast, confidence disappeared, and panic spread across exchanges. It was a major reminder that when markets become too greedy, they always correct. But this event didn't end the bull market. Bitcoin quickly stabilized near its 20-week moving average, which has been a reliable support line in every past cycle. Ethereum and Solana showed the same behavior, holding strong at their key technical levels. The market simply removed excessive leverage and gave long-term holders a better entry. In every previous bull run, these large liquidations were followed by strong rebounds once the weak positions were cleared. That same setup is forming again now. Institutional activity also shows that sentiment hasn't changed. ETF inflows for both Bitcoin and Ethereum stayed positive during the sell-off, meaning large investors kept buying while retail traders were selling. The global liquidity index, a leading signal for overall money flow, remains in an uptrend. When liquidity increases, risk assets like Bitcoin and Ethereum usually benefit, and that broader trend has not reversed. This correction was severe, but it did not damage the larger market structure. Bitcoin is still trading in the same range between $100,000 and $125,000 that it has held for months. Volatility is normal in bull markets, and resets like this help remove unhealthy risk from the system. With leverage cleared and sentiment back to fear, the market is healthier than before. Historically, that kind of reset has marked the beginning of the next strong move higher. The coming weeks will confirm whether this support holds, but so far all signs point to this being a normal mid-cycle correction, not the end of the trend. The immediate recovery after the crash wasn't the only surprise. What came next started to challenge one of the oldest ideas in crypto, that every Bitcoin bull run must follow the same 4-year cycle. For years, traders have relied on the same pattern to predict Bitcoin's behavior, the 4-year cycle. Each one begins with a halving event, builds up through a period of expansion, peaks after roughly 152 weeks, and then enters a long correction. This framework has worked for more than a decade. It explains the 2013 peak, the 2017 mania, and the 2021 top. But this time, things aren't following the old playbook. The latest sell-off may look like the start of another downtrend, but the data suggests otherwise. The current bull market has already surpassed the typical cycle length, yet key indicators like on-chain accumulation, long-term holder supply, and realized price show no signs of exhaustion. In fact, long-term holders are adding, not selling. The average cost basis of new entrants is still far below spot prices, showing there is room for growth before the market overheats. The 20-week moving average continues to hold, a level that marked strong support in every mid-cycle phase. All of this points to the same idea. The structure remains bullish even if the timeline has stretched. What's changing now is the source of demand. In previous cycles, Bitcoin relied heavily on retail speculation. Today, that has shifted to institutional and corporate buyers. ETFF products are absorbing record amounts of Bitcoin, removing supply from the open market. Every time a major bank or asset manager adds Bitcoin exposure, they are reducing the float available for traders. This growing supply shortage could be one reason why, despite massive liquidations, prices have held above $100,000. That kind of resilience is rare and often signals that larger players are supporting the market behind the scenes. Some analysts worry that if the 4-year rhythm breaks, it could confuse investors who depend on those historical patterns. But breaking the cycle might actually be the most bullish outcome possible. If the market stretches into a 5-year expansion instead of a 4-year one, the upside potential multiplies. Liquidity, institutional participation, and corporate adoption all expand gradually, not instantly. And that slow, steady growth creates a more durable foundation for Bitcoin and Ethereum to keep climbing well beyond this year. The next few months will show whether this new structure holds. If it does, Bitcoin's current consolidation could be the start of a longer, stronger bull market, one that refuses to end when history says it should. As analysts debated whether the cycle was breaking or simply evolving, new data began to confirm that the broader setup was still intact and that some of the boldest year-end predictions were already starting to look within reach.
I think it's good to see Bitcoin at all-time highs as we're entering the fourth quarter and not correcting or in the 90,000 level, because we are in that seasonally strong period and the Fed is easing monetary policy. So I'd say it's good to see an all-time high because this is confirmation. And of course, it's only early October and I think there's still room for upside into year-end. Year-end, our target for Bitcoin is 200 to 250,000. And for Ethereum, somewhere between 10 and 12,000 each.
Tom Lee, one of the earliest Wall Street analysts to embrace Bitcoin, believes this year's fourth quarter could mark the official confirmation of a lasting bull trend. In his latest outlook, he said it's encouraging to see Bitcoin holding near all-time highs as the year enters its strongest seasonal period. With the Federal Reserve now easing monetary policy and global liquidity rising, Lee expects prices to climb even higher through the end of the year. His targets are ambitious but grounded in data. Bitcoin between $200,000 and $250,000, and Ethereum between $10,000 and $12,000. For him, the logic is simple. The combination of monetary easing and seasonal strength has historically created ideal conditions for risk assets, and this time, Bitcoin is positioned at the center of that shift. When interest rates fall, capital tends to flow into assets that can outpace inflation and debt expansion. Bitcoin and Ethereum are both limited in supply, making them natural beneficiaries of renewed liquidity. The recent correction has only made them more attractive by resetting leverage and cooling speculative excess. Institutional demand continues to reinforce that optimism. ETF inflows are running at one of their highest levels since launch, and every week new firms announce plans to integrate Bitcoin and Ethereum exposure into client portfolios. It's not just investment firms either. Corporate treasuries are once again exploring digital assets as part of their balance sheet strategy, a trend that began with MicroStrategy but is now spreading quietly across the tech and energy sectors. This growing wave of long-term demand adds pressure to an already limited supply, supporting Lee's high-end price targets. Even in the face of short-term volatility, the long-term setup remains strong. The macro environment, historical patterns, and structural trends all point toward more upside as the year closes. If the market continues holding above key moving averages through October and November, those $200,000 and $10,000 levels may arrive faster than most expect. And while price predictions always invite skepticism, the reasoning behind them is hard to ignore. The same forces that fueled past breakouts are now aligning again. What happens next could define not just the rest of this cycle, but the start of Bitcoin and Ethereum's next major expansion. And if you want to stay ahead of these signals and know exactly when the market's heating up or when it's giving you those rare buying windows, I break it down every day in the Crypto Nutshell, my free 5-minute daily crypto newsletter. It's built to give you quick, actionable insights so you can make smarter decisions without spending hours buried in charts or headlines. You'll get clear signals on when to buy, when to take profits, and the latest news that could move markets, all delivered straight to your inbox. Just click the first link in the description, enter your email, and you're in. Now, let's go back to the video. After the historic shakeout and Tom Lee's bullish outlook, attention has shifted to what comes next. The signs of recovery are already visible. Bitcoin has stabilized above the $100,000 level, with strong buying activity returning across major exchanges. Ethereum has regained its 20-week moving average and continues to attract steady inflows from institutions. The panic that once dominated the market has cooled, replaced by quiet accumulation. Historically, this phase marks the point where smart money re-enters before the next major move begins. On-chain data supports that view. Exchange reserves of Bitcoin have dropped to multi-year lows, showing that investors are moving coins off platforms and into cold storage. That behavior usually signals conviction, not uncertainty. The same trend is visible for Ethereum, where large holders, including corporate treasuries, are increasing exposure while the broader market remains cautious. The result is tightening supply, which often leads to stronger price performance once demand returns in force. Macro conditions also continue to favor risk assets. Global liquidity remains in an expansion phase, supported by lower rates and rising money supply in major economies. The Global Liquidity Index still points upward through November, suggesting more capital is set to flow into markets. Historically, that kind of environment has lifted both Bitcoin and traditional equities together. The last time this pattern appeared, during late 2020, Bitcoin rallied over 300% in 6 months. There's also growing confidence among analysts that the sell-off created a base rather than a breakdown. Bitcoin's price remains within the $100,000 to $125,000 range, forming what many see as a consolidation zone before another leg higher. When similar setups happened in previous cycles, they led to explosive moves once the breakout came. For Ethereum, the range around $4,000 is showing the same resilience, supported by ETF inflows that continue to absorb supply. If this stability holds through the next few weeks, the conditions for a strong fourth quarter rally will be in place. A clean base, expanding liquidity, and renewed institutional interest make a powerful combination. Every sign points to this market resetting for growth, not decline. The next question is how far this recovery can go before the year ends and whether the altcoin market will finally follow Bitcoin's lead. Altcoins are finally showing signs of life after the record liquidation. While Bitcoin and Ethereum have stabilized, smaller projects are still trying to recover. Historically, altcoins begin to rebound once Bitcoin's price finds support, and that pattern seems to be starting again. Bitcoin dominance has stopped climbing, and Ethereum is regaining strength against Bitcoin, signaling that money is beginning to rotate back into higher risk assets. Solana has been the clear leader in this group. It held both its 20-week and 50-week moving averages through the crash and is now seeing renewed attention from investors and corporate treasuries preparing for future ETFF listings. That stability has turned Solana into a favorite for those looking beyond Bitcoin and Ethereum. The broader market is following similar signals. The Russell 2000 index, which often moves in parallel with speculative assets, has started to recover, hinting that risk appetite is returning. If liquidity keeps expanding through the year, altcoins tied to real utility, especially in artificial intelligence, gaming, and decentralized infrastructure, could lead the next rally. The recovery is slower than Bitcoin's, but it's building strength. Once the foundation settles, the next breakout could come faster than anyone expects. Monetary policy is now turning into a major tailwind for crypto. Central banks are shifting toward easing, and the Federal Reserve's latest moves signal that lower rates are coming. The Global Liquidity Index remains in an uptrend, showing that money conditions are improving worldwide. When liquidity expands, it fuels risk assets first, and Bitcoin has always been among the top beneficiaries. With deficits still growing and currencies weakening, the case for scarce digital assets is stronger than ever. Each rate cut pushes more capital into markets that protect value, and Bitcoin continues to lead that trade. Anyway, guys, that's all we have for today. Thanks for watching, and I'll see you all in the next video.